Welcome, everyone, to another edition of Lending Leadership with the Mortgage Pros. I'm here with Tom Mills and Robert Filia. How you guys doing this morning?
Good, man. How are you?
Good. So one of the topics we're going to hit on today, and it's seemed like it was timely for a minute, maybe not as much now with rates going up, is refinances and how to be ready for them. And we'll be looking, hopefully, at a refinance boom sometime here the next 6-12 months. So let's get into and start off. What defines a refinance boom? What is it?
First, it was kind of funny. We thought for about 36 whole hours we may have been in the middle of or getting at the start of one, and then
We're here. This is what we've been talking about. This is what we've been planning for.
The second time, because I think we had a false start in the fall too.
Yeah. Wah, wah, wah.
yeah, I think it. What that really teaches you a lesson to kind of always be ready, though, right? If you're not, you're going to lose more. Your question: what constitutes a refi boom? I've always been told, and I think when you're 30% of your business is refinance. I know you can look across like the industry, and you may see that some companies are higher, but they're more like refi focused. I think for like our audience, self-generating originators,
Money shop.
purchase money focus. I think when you're 3 out of every 10 loans you're closing is a refi. I think you feel like you're boom. That's a really nice pickup, especially if you're running in a good spot before those refis came in. I think that's a boom.
I would agree with that. We may not see a boom, right? I mean, if 20% of our business is refinances, I'll certainly take it. And a lot of that's geography too. For our listeners that are in California or higher loan amounts in Massachusetts or New York State or wherever that case may be, you'll be able to refinance a lot more of your customers because larger loan amounts and you need less of a spread to do it.
That was also much more of a story, years ago, but the conventional loan limits, since COVID really come up dramatically in all markets, and the average loan amounts come up dramatically. It's that over that $300,000 loan amount, it's 0.5% to 0.75% in a drop. You've got a significant monthly savings to a family that may be feeling a pinch right now. With all things going on, that's significant to a lot of households.
Absolutely.
Yeah, I agree. I think it's that 30+% would constitute a boom, but I also agree with Dave. Right? There's not an originator out there that if you talk to and said, "Hey, if your business were to increase by 10 to 20% with refis, would you take it?" Every one of them is going to say yes, right? So I think the real question is, are you ready to take it? Like, are you doing the things necessary to be ready to capture the business as fast and as efficient as possible? Because I think what we've seen, guys, we joke about, this 36-hour window and the blip that we saw in the fall. I think with the volatility in the market, this is what we're going to see. We're going to see microbursts of the rates dropping, and you have a span of 3, 4, 5 days where you can capitalize on it, and then maybe they move back up, and so those clients are out of the game again. So if you're an originator out there and you don't have your systems ready, you haven't done the things to be prepared, when the rates fall, if this does hold to be true, you're going to miss the boat. You're not going to have time to get the clients ready and do the things you need to do. The rates are going to be back up.
What are the things to be prepared?
That's a great question.
You need to be in touch with your database on a regular basis. Especially clients, let's just use a number, draw a line in the sand, 7%. All clients with rates over 7%, you should have been in touch with the last 3 months via email and verbally on the phone, or at least leaving voicemail messages. There's money in voicemail. They know you because I can tell you, look at Rocket acquisition of Mr. Cooper. Big companies, big servicers like Mr. Cooper, they're going to be ready. Yeah, they're ready to call your customers. They're ready to. What was the stat? They retain 68% of their customers. So that's your customers.
Mm-hmm. Yeah, because they're buying service releases, and they're taking those customers in, and if 6 out of 10 you can lose, but you can also be the loan officer that, that catches, 7 out of 10, and that's a realistic number because, as great as you are, it's hard to really catch every opportunity. It's really hard. But, I think the biggest thing, you think about, like Dave, you mentioned everybody over 7%, you can look at it that way. And, if you're behind and you haven't been in regular contact with your database, that's probably where you should start. Most definitely, the low hanging fruit first kind of mentality. But I really think that self-generating originators need to stop thinking about the term past customers, and just start calling them customers. Because if I've done a deal with that customer, they're probably going to do 6 to 8 more deals. They have a sphere of influence of friends, family, and coworkers. They're a customer, and if you've done a great job and created a raving fan of that customer, it's simply just conversations you don't have to wait for the market moves. You don't have to, try to worry about getting in front. When you're doing, I think, strategies through 12 months a year, regardless of the market, you're in the driver's seat with the vast majority of your database. And Dave, I know you referred to it as a database because I know you don't look at it as just a past customer. But I think that's the fundamental difference between those that really feast in these opportunities and markets and those that are just chasing and hoping that they don't miss out.
I feel like the last boom in 20 and 21 was easy. We'll look back and it was easier.
It was more plentiful. There was way more. Like there was so much for everyone.
Yeah. And the servicers couldn't get to it quick enough. But I think a lot of these servicers, their retention departments have been sharpening their knives, waiting for this moment. And I think it's going to be more difficult. I mean, I always said you can walk in a grocery store, pick up an orange and throw it across and it hit someone who needed the refinance. It was that easy. Basically, everyone in America that had a mortgage had an opportunity to refinance it, like 90%. We're not going to have that anymore. So you need to be focused. And as Tom mentioned, if you've not prepped your systems, if you're not ready, if you've not reached out to your past customer database, you're going to be behind. You're behind the 8 ball for sure.
Well, no, I think that's a good point. I mean, these servicers, it's going to be a dogfight, right? So you need to do things to position yourself with your clients to make them want to do business with you, and you be their trusted advisor versus solicitor that's calling them out of the blue, trying to retain servicing runoff, right? Because that's what's going to happen, guys. So I think, the other thing we need to talk about is how do we build our systems and our teams to make this as quick and as efficient and easy as possible. This is, when I say low hanging fruit, like this needs to be like a 10 to 12 minute conversation. Customers bought in and you're running the closing and you're trying to turn these things in 15, 20 days. Like they need to be quick, easy, slam dunk turns. Otherwise, the servicer is going to get involved and they're absolutely going to undercut you on price. It's going to be a knife fight in the street and you're going to end up bleeding out.
Because they're going to take deals. They're going to take things tighter than most people listening to this podcast are able to do. And I mean, we've seen situations in competitive dogfights where the servicer basically took it down to no profit margin, to where, we were not making, even before paying the LO, there was zero profit margin. Obviously, we cannot work for free. So some of the strategies we talked about to retain the customer and to not alert the servicer are doing a soft pull and doing a hard pull at the last second, like a week before closing, as well as not having the title company or us order the payoff till about a week before closing. That way, CD's out, loans clear to close, things are signed. It keeps them a little stickier. What other strategies, just brainstorming, guys, can we do to kind of retain that client away from the servicer?
Well, as I mean, I think first and foremost, it's in front of the communication, not behind it. If you're the first one talking to them 6 months before the timing becomes a reality to refinance, you're very much in a driver's seat much less likely to lose the customer to the outreach. It's going to come from the servicing department, much less likely for them to even entertain it. You may have them, tell you that they called and offer that, and you got to match it, And I think, as you guys know, we've talked about that importance of having an internal retention strategy. Like sometimes loan officers, like you may have to forgo, maybe your company lets you forgo your income, have a way to get that loan done to keep that customer from being marketed in your database, not, and not going back to that, that same servicer to stay there forever. I think, you have to, there's a value to keeping the customer and then really learning from that and making sure that you're doing the things going forward to stay in front to catch, like I said, those next 6 to 7 deals that they may be doing.
Yeah, I love what you said about the early reach out, Tom. Like, I think that's so important. Dave, you mentioned also talking to your database, like the conversations that should be, like you should be building your bench of refis that are ready to go, right? Like have the conversation, go ahead and look at numbers and say, hey, Mr. Client, you're at a 7.25 now, right? When I can do an FHA streamline for you at 6.5 and it does this is what it looks like. Would that be enough? Like, is that enough to move the needle for you? And have those conversations and have that list of clients built. And then the minute this starts happening, now all you're saying is, hey, great news, we're there. I'm getting it started. Boom, 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 right? Yeah. Have your templated emails ready with the needs list. Have all of this stuff plug and play so you can grab as much of this as possible as fast as you can. And then you just make it really easy to close. Like the people that get ahead of it and have those lists built and heck, maybe even have files structured, right? Don't trigger them. You don't want them hanging around in your active pipeline, but have the file structured, have it ready to go. Know what your targets are. And then it's a really simple, easy call to that client. Hey, great news. That target we talked about for your refi, we're there. I'm getting the ball moving today for you. Bam, done.
And I think that's with the rate and terms, right? But sometimes like your cash out, like, that doesn't always stand out to you. Like it takes those conversations. And, we've had great success with annual reviews, because if you're doing annual reviews, like you're once a year really kind of talking about their debt, right? And, really we're here to help them manage their debt, and their largest asset that most of our, customers have is the equity in their homes. So, we're helping them manage it through that. We're finding those opportunities, and that's where you have conversations and you learn, like, if this were to be the case, then that customer would be really interested to jump all over it. And like you said, Robert, it's just a phone call and, hey, let's go. We're going to skip our next 2 payments. We're going to free up that $600 a month and pay this off and do this.
Well, the cool thing, Tom, hold on just a second, Dave. I know you want to jump in. The cool thing about doing the dials now and setting that up, it's what I call you'll get the now and later, right? Because some of those conversations are going to uncover cash out needs that are there now that you guys aren't having the conversations with. So you'll get some of that business now, do the cash out, and then you'll also be stacking that list for later.
I love that. Now and later, and then you can potentially get referrals. You're staying top of mind. Yeah, I like that, Robert. A lot of it's to stay in front of the customers, making the phone calls, putting in the work. We kind of like to future cast our people, right? And say, hey, Robert, you're at 7.5%. Here are the numbers at 6.5. Here's the savings. We're not there yet, but I'm going to call you when it's 6.5. Is that okay? Like get their permission to do it, and have the numbers ready, have everything ready to go. Have the file built in your LOS. A lot of these refis are going to be easier as well too. You're going to get a lot of PIWs. You're going to get 1-year W-2s, 1 year, 1 or 2 pay stubs. It is going to be significantly easier. A lot of them are lower LTVs. They're, high quality borrowers. So you should be able to jam those in and out of underwriting very quickly. And your company should have an operations built. I mean, I know in 2021, different times, I know, we paid our underwriters a per file bonus to work on the weekends. And they could come in and each underwriter could, grind out 7 or 8 refinances, make an extra $1,000 or $1,500 in the weekend. Who doesn't want that? And we were able to just burn through our refinances really quick. And they're easier deals.
Well, the big thing is to, not lose anything service-wise, a beat, don't skip a beat on your purchases, and don't skip a beat on your on your prospecting of your purchases too. We see a lot of loan officers do that. And then we see agents posting about, oh, I'm not getting outreach for coffee meetings anymore. Refinance season must be in. And loan officers just hiding, finally calling their database. And, that's silly. Like if you're doing it, that's another difference too, that impact that you don't even think about when you're calling your database and working your database strategy all year long. When the season hits, you don't have to like entrench yourself into it. Like you said, it's conversation disclosed. Your team's just making the phone calls. You're just having short conversations and loans are moving in and out. And you're able to maintain your purchase prospecting, which is really where you get an opportunity to make up a lot of ground. If you're, if you're looking to gain new partners, that is always a good season for it.
It's a great season. I can think of probably 5 relationships off the top of my head that I know that originators were working. And then in 2020 and 2021, the lender that realtor was using got so refi focused that they dropped the ball on the purchase, and our lenders moved in, and now they have those realtor relationships. Mm-hmm. So that's a great point. Having this pre-planned and being ready for it will make sure that doesn't happen to you and you don't sacrifice your purchase relationships, because that's the stuff. That's what I call the everlasting, guys. That stuff's always there. A refi boom is called a boom for a reason. It doesn't last. It's not here always. So you can't let that sidetrack your everlast business.
Here's a news flash. You may have to work a little harder. You may have to put in some additional early mornings, nights, and weekends when this happens, because it comes quickly and unexpectedly, right? Like look at COVID. I remember in February of 2020, I was in a conference down in Florida watching the 10-year drop out, 10-year treasury. I'm thinking, man, I wish I was back in the office making phone calls. It can happen unexpectedly, and it can end unexpectedly as well too. Usually happens quicker, and then it ends slowly. So let's get into some real strategy and some practical advice. I mean, guys, and this could happen. What happens if over a week period rates drop a full 1%? Like, what do you do? Like,
feast.
Yeah. What do you feast? What do you do? Except, hit the mattresses, put a mattress in your office and just work.
You kiss the wife and kids and say, all that family time we've been having is nice. I see you.
So what are some strategies if rates drop 1% over a 1 week period? I mean, again, you gotta be prepped and organized, right? So I would encourage our listeners who are listening today, have a plan. Have a written plan for yourself, have a written plan for your team, make sure your company's prepped. I know we're prepped and ready to go, but so 1 week rates drop 1%. What are some of the action items that you do?
I mean, the 3 major outreaches are call, email, text, right? So all 3 at the same time, simultaneously, not waiting for any first, second, or third approach, regular, consistent outreaches, welcoming text because I would have been in front of my database. And it's like, hey, Dave, it's Tom. You probably see in the market, watching the news, rates have moved. A lot of people are reaching out to me. So I wanted to reach out to you, grab some time on my calendar. Let's grab 15 minutes and chat. I'll answer any questions you have. Really, I'm not here to sell you. I'm just here to answer questions you have because you have seen the news, and you are a part, especially. It seems like everybody's always watching interest rates, always watching interest rates, whether you own a home or you're thinking of buying a home. People are watching mortgage interest rates. It's the conversation I have most with people that are outside of our industry. They always ask, they know you're in the mortgage industry. They say, what are rates like? So just having those conversations. And then I think, as we're big on automation, give them a convenient way to book time with you, instead of going back or thinking I'm going to catch them at 2:00 in the middle of their day or 6:00 in family time or when they're at baseball, schedule some time with me. I make it really easy for you via text, email, phone call, outreaches. And you always know if you're not making the phone call, and you should have somebody making the phone call to book it to somebody that's going to do a quick analysis there. Make it a really efficient call.
If you're not calling your past customer database, someone else is. 100% someone else has it.
I think the key to remember here, right? We wake up and rates of move out point is that boom, right? This is a short window of time to maximize as much business as you can, right? So ideally you're prepared and you have your list segmented, right? You want to grab the low hanging fruit first. And what I mean by that is the easier refinances, right? Your EARLs, your streamlines, your rate and terms with an 800 bar at a 50% LTV, the one and done stuff, the stuff that gets through, right? You almost have to triage this a little bit, because that 3-hour conversation that you get into trying to sell someone on a refi and trying to work it out, you could have put 6 deals in the pipeline, right? So you have to, this isn't, I don't want this to sound the wrong way, but there may be conversations that you have to sideline to grab other conversations to get as much in the pipeline as you can during this boom, right? Like that. I really think that's going to be the world that we live in, because I think we're going to have microbursts of it, right?
Yeah.
The more prepared and the more conversations you have up front, the more list you have built, the more people you have sitting on G waiting for O, the better you're going to be able to capitalize on this.
And I think, don't just rely on your customer database. You have your sphere of influence on social media. You have your customers. You're doing your pal calls. You're doing, when rates are on the move, people are buying houses. People are doing transactions. They tell other people they're doing a refinance or they're buying a home. And people ask questions, and you ask questions enough and you get somebody's name and phone number, and, it gets that next opportunity before they could reach out to their servicer when you didn't even have a relationship with them. And that's important. You have to take a multiple prong approach, and it is a numbers game, and you're not going to get them all, no matter how good you are. It gets really fun, doesn't it, when we start getting those attacks like, hey, I got 6 purchases, 6 refis this week, seeing loans flying out the door. It's a lot of fun.
And this is something you guys can get really proactive with, right? We were just at our sales rally, and someone spoke on building a funnel, and basically it's super easy. They're putting it out there on all socials. Rates are going to drop in the not too distant future. A lot of our sphere of influence is going to have the opportunity to refi. If you would be interested in that when the time is right, please let us know. We'll put you on the list and we'll monitor this for you, and we'll take the heavy lifting out of it. We will do it for you and come to you when it's time. And what are they doing? They're building the list that we're talking about, and they're getting just a little bit of information. They're having the conversation, and they're kind of setting the hook. And then when it's time, you reel them in. Like, if you're not, I can't stress this enough, guys. If you're not doing this now, if you're not having these conversations now, you're going to miss the boat.
Do this starting tomorrow after you listen to this podcast. Get a list of your top 25 clients. And top 25 clients, what I mean by that, what Robert said, your VA EARLs, maybe your FHA streamlines, maybe the larger loan amounts with the higher interest rates. I have mine ranked based on interest rates, and then look at the loan amounts. Have it ready to go, and call at the very least. Everyone can make 25 phone calls in a week. Call your top 25, leave them a voicemail message, or schedule a call with them. And I 100% guarantee it will pay dividends. Like Tom said, educate them. There's a lot of talk about interest rates. There's a lot of stuff going on in the news. So it's easy to cut through that. And then when the next Fed meeting, whatever happens at the next Fed meeting, they're going to call you for advice and expertise.
Mm-hmm. And if you haven't been calling, don't feel like, it's too late. I haven't been doing it. Because Robert, what are they not going to say when you reach out?
They're not going to say, "Oh, Tom, I haven't heard from you in 5 years."
Where the hell have you been?
No, not at all.
Hey, thanks for the call. And just business as usual. Keep it casual. Had conversations. Like, that's the thing. I mean, don't just pick up the phone to sell them. Just pick up the phone to call them. And if you're doing that more consistently, you're never selling your customers. You don't have to sell your customers. You just have to make together informed decisions on when it's best for them to make moves together.
That's well said. Yeah, and it's the crazy thing about the conversations when you're calling just to check in, and it's conversational, you don't know what's going to open up, right? Like that, and that's where you can maybe get into some of the cash out conversations and just see where it goes. Mm-hmm. We could preach a whole session on past database calls and the reason you should be making them. This is just even more, right? Like, hopefully you guys are doing these regularly, and not, this is just more reason to do it.
And ask for a referral too. Hey, anyone else I should be talking to? Friends, family, and coworkers who are looking to possibly refinance that have purchased the last 3 years. I love to help them too.
And do that in every market. It doesn't need to happen when rates drop. That's in every. Honestly, you should be as an originator, you should say that phrase almost every day.
Absolutely.
Every conversation, I would say. You know, one interesting piece that we haven't touched on a whole lot that I want to spend just a minute on is, as an originator, you know, we're talking about what you can do to be prepared and be ready, but you need to make sure your company's prepared and ready, right? Like we saw some crazy things when COVID, and guys, I don't think this refi boom is going to be anything like 20 and 21 was, right? We've talked about that. It's going to be a percentage of that. But there are still going to be companies out there that run into operational challenges and bottlenecks, and they're going to do things like, you know, jack rates up to slow down volume coming in, right? They're going to do things, extend turn times, right? So it's going to be really interesting, I think, as we see this next boom to see how companies respond to it. So as originators, that's something you guys may want to have some questions with your leadership if you're not sure. Hey, if this refi boom happens, what's our plan? As an originator, what I'd be looking to hear is purchase business is going to remain our focus. We're not going to jack pricing up to interfere with your ability to bring business in. And we're going to basically staff and price as we need to get your deals done for you.
If you're struggling operationally now, and you get a 30 to 40% increase, you're toast. I mean, listen, we struggled operationally in 20 and 21, but so did every single mortgage company in America. I thought we handled it better than most. But if you're struggling now, and if your leadership cannot give you a clear plan on what happens when the refi boom, I mean, we have a plan. I mean, we're going to overtime, weekend work. A lot of our underwriters and staff will grab that, and we're going to hire. I always say hire till the pain goes away.
Your competition, the servicers, they have a plan. They have a plan. That's a fact. So, you know, it's important that we have one. Each loan originator has one, because it's you know, you really have to work together with your company to capture that. You know, their use of automation and things like tools they can provide you to, you know, really get in front of faster, more people. Sometimes there's everybody's got a plan, and then sometimes all chaos breaks loose, and old Mike Tyson comment, everybody's got bread punch in the face. That was the last refi boom. It was like everybody thought they had figured out, and then bam, they're punched in the face and just reeling to try to get deals closed. And you know, it was fun. There was a lot of money being made, and a lot of customers really look at the money that was freed up. Look at that different economy. Look at, you know, households that you were saving thousands of dollars for a monthly. Like, that was fun.
Well, I always say about the refi boom of 20 and 21, fake business, real money. I knew the amount of business that I was doing was not sustainable. I know I wasn't that level of a producer. I almost closed 200 million in 21. That was fake business, but it was real money, right? And allows, you know, let's face it, the last 2.5, 3 years have been a very rough time in the mortgage industry. When you get a little refinance boom like this, it allows you to get healthy. And, you know, maybe we'll do a whole episode on this, and a little advice to all the LO friends who are listening. Don't think that income is sustainable, right? Take that little extra refi money that you get, put it to the side, because it's not going to last. That's a
whole nother session, Dave.
It is. I'm just putting it out there. That money isn't going to last. Stuff it away. Pay off some debt.
Definitely.
Great episode.
Amazing, but
I think it was timely. Some good stuff there. For those of you that, you know, haven't really been on it, you know, going it, happy to help anybody individually, schedule time with us, build a plan, get in front of it, because there's some opportunity right now. The opportunity is going to open up more as our purchase opportunity is opening up more. So, you know, it's really, really good time to get buckled down, have a good process built, have a good plan in place, and take advantage. You know, we come off a pretty decent, you know, really, you know, give off a pretty decent Q1 for our industry. The market still hasn't given us a lot, but, you know, I came into the year, like tail end of the year after we'd had that like rise in rates and then, or that drop in rates, and it kind of rose back like, man, this may look a little bit like, a lot like 2024, but I'm seeing a lot of things that tell me that there's more hope than that, and that we can have a really, really strong second half to this year. So, how strong everybody's second half and, second quarter and then second half is going to be is all about, that plan, the process in place, and how we're maximizing time and opportunities, I think.
Yeah. So call to action, get your top 25 list. Everyone can make 25 calls. You're going to get a lot of voicemails. Do that and then move on to the next 25. Everyone can do that. Get it prepped. Be the circle of influence with your customers. Ask for referrals because you'll get some purchase business out of it and potentially some other refinances.
I love it. I love it. Good stuff, guys. Wrapping up. Any last ads?
Hoping and praying.
Closer than we've ever been. We are closer than we've ever been. So, guys, thanks for joining on this episode of Lending Leadership with the Mortgage Pros. Go ahead and leave us that 5-star and smash that subscribe button. As always, we appreciate you joining us. For Dave and Tom, this is Robert Filyaw. Have a great day.
Thanks so much.
Thanks all.